Darasa. In our session today, I want to take you through a topic in advanced financial reporting and analysis, which is under assets and liabilities. Specifically, I want to take you through a subtopic under assets and liabilities known as share-based payments. Share-based payments. Share-based payments is governed by a standard. It is governed by a standard we call IFRS 2, International Financial Reporting Standard number 2. Now, introduction. You write, put down this. Share-based payments arise when an entity pays for goods or services supplied. An entity pays for goods or services supplied using either its equity instruments, or using cash, which is based on the entity's market value of equity instruments. Entity's market value of equity instruments. Full stop. There are three types of share-based payments. Namely, number one, types of share-based payments. Number one, we call it equity settled share-based payments. Equity settled share-based payments. An explanation on the same. It arises when an entity pays for goods or services supplied. Using its own equity instruments. Into brackets, ordinary shares. Number two is known as cash settled share-based payments. Number two is called cash settled share-based payments. It arises when an entity pays for goods or services supplied. Using cash, which is attached to the market value to the market value of the entity's equity instruments. Attached to the market value of the entity's equity instruments. Number 3 is known as choice/option settled. Choice/option settled share-based payments. It arises where the suppliers of goods or services, are given a choice, either to accept cash, or the entity's equity instruments. Either to accept cash or the entity's equity instruments. Then after that, a sub-heading below that, measurement and treatment. Measurement and treatment. Measurement and treatment of share-based payments. The amount of share-based payments arising in a given accounting period, should be weighted on time basis of the vesting period. Full stop. Equity settled share-based payments. Should be measured using the fair values of the options, as at the grant date. The fair values of the options as at the grant date, i.e., that is, the commencement date of the share-based payment scheme. The commencement date of the share-based payment scheme. Full stop. Paragraph below that. Cash settled share-based payments should be measured using the market values of the instruments as at the end of each year. As at the end of each year. As at the end of each year. Full stop. The cumulative amount of share-based payments should be treated as a reserve, in the statement of financial position. Should be treated as a reserve in the statement of financial position. Full stop. Full stop. The amount of expense arising in each of the years should be expensed in the income statement. Should be expensed in the income statement. Should be expensed in the income statement. Full stop. Full stop. So you need to know what is a share-based payment scheme. After that, you know the types of share-based payment schemes. After that, you know the measurement and accounting treatment of share-based payment schemes. Now, after that, you need to know how to compute the amount of share-based payment scheme and how to present it in the statements of in the financial statements. Now, to be able to do that, I want us to refer to 2 or 3 past paper questions, starting with September 2021. Starting with September 2021. Let's get to September 2021. September 2021. September 2021. Let's get there. September 2021, question 3B. September 2021, question 3B. The question reads, 𝘱𝘋𝘈 Limited decided to grant its 500 employees 200 share options, each from 1st of July 2021, on condition that the employees will still be in employment as at 30th June 2025. The company has provided the following details regarding the share options, and you have been given 4 years, year 1, 2, 3, 4, number of employees expected to leave employment, and the fair value of each option as at the end of each of the financial years. The fair value of the options was 40 as at 1st July 2021. That is what we are calling the grant date. That is what we are referring to as the grant date. The date or the commencement date of the share-based payment scheme. And now that is the most important value. Actually, the other values, the fair values at the end of the fair values of each year, the end of each year, will not be applied. What we are going to apply will be the fair values of the options as at the grant date. The exercise price of the options was 15, and the par value of the company's share was 10. the average market price of the share over the 4-year period is expected to be 50 shillings. You are required to show extracts from the financial statements of 𝘱𝑃𝑃 Limited for each of the years ended 30th June 2022, 23, and 24, and 25 to reflect the above transactions for you to earn yourself 8 marks. Therefore, solution to that, you'll have a column for here. Again, we are going to tabulate it. Here, SFP extract. And then income statement extract. This is what we call the cumulative expense, SFP extract, or in other words, the cumulative expense. And then the expense for the year. In the year ending 30th June 2022, I can see this company had 500 employees, and in the first year, 40 employees are expected to leave employment. Therefore, out of the 500 employees, if 40 employees leave, you'll be left with 460 employees, which is 500 minus 40, times the number of options being granted. From the statement I can see the number of options being granted are 200 share options, and each option measured at the grant date has a value or a fair value of 40 shillings. And since we are in year 1, you weight it over 1 over the total vesting period, which is 4 years. So times 1 over the total vesting period, which is 4 years. Once I do that, using my calculator, 500 minus 40, I'm left with 460, times 200, times grant date fair value, which is 40, times 1 over 4. It gives me 920,000. And since we are in year 1, the expense for the year will be that one minus 0. So it will still be 920,000. Once we get to 30th June 2023, I had been left with 460 employees, and I can see in the second year another 30 employees are expected to leave. So minus 30 times 200 times 40 times 2 over 4. So 460 minus 30 times 200 times 40 times 2 divided by 4. I'm getting 20,000. To get the expense for the year, I subtract the cumulative expense of the previous year. So minus 920,000. It gives me 800,000. Then I get to 30th June 2024. I had been left with 460 minus 30, which was 430, times 430 minus those expected to leave in the third year. I can see from the question another 25 are expected to leave in the third year. So minus 25 times 200 times 40 times 3 over 4. So this is 430 minus 25 times 200 times 40 times 3 divided by 4. This gives me 24,30,000. So once I subtract 1720, it gives me 710,000. Finally, 30th June 2025, I had been left with 405, and I can see another 25 are expected to live in the 4th year, times 200 times 40 times 4/4, or rather times 1. So 385. So 380 times 200 times 40, it gives me 40,000. Once I subtract the cumulative expense of the previous year, I get 610,000. Therefore, these are the figures which will appear in the SFP of each year, that is a statement of financial position, and these are the figures which will appear in the income statement of each of the 4 years. And that's how you present a share-based payment scheme, both in the income statement and in the statement of financial position. For purposes of improving our understandability, we are now going to look at another question. So let's get to 2017. Let's get to 2017. Let's get to 2017. Let's get to a question from November 2017. Question number 2B. November 2017, question 2B. November 2017, question 2B. November 2017, question 2B. The question reads, on 1st January 2014, P Limited promised to pay its 200 employees a bonus in cash that would be based on how the company's share performed on the securities exchange. The bonus was to be paid on 31st December 2016 at 2016. The market price of the on condition that the market price of the company's share was 55 and above, and that the employee was still working for the company. So there are two vesting conditions in this case. There are two vesting conditions that must be fulfilled. The first vesting condition is that the employee must remain in employment, and the other vesting condition is that the share price must at least be 55 and above. It must be at least 55 shillings and above. Then you are told, on 1st January 2014, the market price of the share was 50, and the par value of the share was 10. The bonus was equivalent to 100 shares. Now you've been given the year, the number of employees leaving, the market price of the share, and all the employees who were in employment as of 31st December 2016 were paid the bonus. Then you are required to show how the above bonus would be accounted for and reported over the 3-year period, and for the 3-year period ended 31st December 2016. So year, then cumulative expense, then expense for the year, expense for the period. The first year is ending 31st December 2014. Cumulative expense. These guys are 200 employees, but we are expecting that 10 would leave in year 1. So 200 minus 10. You are left with that 190, and the number of options is equivalent to 100 shares times 100, and the price as at the grant date 1st January 2014 is indicated as 50. And then the weighting factor of year 1 compared to the total vesting period of 3 years times 1/3. I take my calculator, 200 minus 10, I'm left with 190, times 100 shares, times 50, times 1/3. It is giving me 316,667. And since we are in year 1, it will still be the same minus 0. For the year ending 31st December 2015, it will be 190, those who are left last year, minus those expected to leave in year 2, which is 15, minus 15, times 100, times 50, times 2/3. This gives me 175 times 100 times 50 times 2 divided by 3. It gives me 583,333. 583,333. I subtract the cumulative expense of the previous year minus 316,667. It gives me 266,666. 266,666. Finally, year 3 ending 31st December 2016, I had been left with 175 employees, and another 15 employees are leaving in the 3rd year. So times 100 times 50 times 3/3, or rather times 1. So 160 times 100 times 50 times 3/3. It gives me 800,000. Once I subtract cumulative of the previous year, which is 583,333, it gives me 216,667. 216,667. And that's how you present the solution to that question, both in the income statement, which is represented by the expense for the year, and in the statement of financial position, which is reflected in the cumulative expense figures. Now, again, let's do one more question, still on the same. Let's do one more question on the same. I want to take you to November 2016. I'm taking you to November 2016, question 4C. 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 The question reads, as part of its staff motivation program, 𝘠𝘪𝘵 Limited decided to grant each of its 600 employees 100 options to purchase the company's shares effective from 1st of April 2016. These options were conditional upon one still being in employment as at 31st March 2020. The following additional details are provided with respect to the scheme: year, number of employees expected to leave, and fair value of each option. The fair value of the options was 25 as at 1st April 2016. That is the grant date. That is the price as per the grant date. The exercise price of the options will be 12, and the par value of the company's share is 6. The average market price of the company's share is 25. You are required to show how 𝘠𝘪 Limited should report the transactions of the above scheme as per the requirements of IFRS 2 share-based payment schemes to earn yourself 8 marks. Now, again, you write year, cumulative expense, and then expense for the period. We are going to start with the year ending 31st March 2017. 31st March 2017. Now, we had a total of 600 employees, out of which 25 are expected to leave in year 1. So 600 minus those who left, minus 25. Now, times the number of options being granted, which is 100, times the price fair value at the grant date, which was 25, times the weighting factor of 1/4 years. 4 years representing the total vesting period. Therefore, I take my calculator, 600 minus 25, I'm left with 575, times 100, times 25, times 1/4. I'm getting 359, 375. And since it is year 1, it will still be the same. The other one is 31st March 2018. This is 575 remaining employees, minus those who left in year 2, which is 15, times 100 options, times the price at the grant date, which was 25, times 2/4, which is the weighting factor for the vesting period. This one gives me 575 minus 15, which is 560, times 100, times 25, times 2 divided by 4. It gives me 700,000. I subtract the cumulative of the previous year. I get 340,625. I get to the third year ending 31st March 2019. I had been left with 560 employees, and another 10 are leaving in the third year. times 100 options times 25 times 3/4. So this gives me 560 minus 10, 550, times 100 times 25 times 3 divided by 4. This gives me 1031,250. I subtract 700,000. I'm left with 331,250. I'm left with 331,250. I get to 31st March 2020. I had been left with 550 minus another 10 who are living in the 4th year, times 100 options, times 25, which is the price as at the grant date, times 4/4, or rather 1. So this is 550 minus 10, which is 540, times 100, times 25, it gives me 1,350,000. I subtract the cumulative expense of the previous year, which was 1031,250. It gives me 318,750. 318,750. And therefore, this is what will appear in the statement of financial position, and the other one will appear in the income statement. Now, having done those 3 past paper questions, I think we have properly and exhaustively demonstrated the concept of share-based payment schemes, and therefore we'll stop at that for today. In our next session, we are going to look at the other part of accounting for assets and liabilities, which will be accounting for employees' benefits. Have a nice time.